Welcome to another real estate industry update. I'm your host, Daniel Roccanti, and today we have the pleasure of hosting Melody Lechleidner, CPA and attorney here at James Moore and Company. Melody leads our state and local tax department and brings a wealth of knowledge in this complicated area. It's important for real estate operators and investors to be up to date not only with federal compliance, but also with their state requirements. Melody, glad to have you here. Can you tell everyone a little bit about what your role is here at James Moore with the state and local tax department?
Sure, and it's great to be here. I have worked in state and local for well over 20 years, but my role here is to really make sure that our clients are compliant in all the spaces related to state tax. State tax is quite a large umbrella, and it basically covers anything that a state could potentially levy in terms of tax. So it could be income taxes, franchise taxes, sales taxes, property taxes, payroll taxes. The states are quite creative these days on ways that they like to levy new taxes. So it's my job to make sure our clients are compliant where they need to be.
Like Melody said, this is actually a very complicated issue. I mean, you've got 50 states here, okay? Most people have at least somewhat knowledge of, I need to file a federal tax return, but now you're bringing in 50 states, potentially 50 other tax returns. And then like you're saying, there's more than just income tax. There's a wealth of other taxes states like to put on us as taxpayers, and you might need to make sure that you're complying with a requirement. Let's start off though with state income tax compliance. Most people are aware, I need to file a federal tax return, but when are you required to file a state income tax return? Usually this is around having Nexus in that state. So Melody, give us kind of a quick summary on what is Nexus?
I laugh at you say quick because Nexus has evolved over the years. So, I mean, at its basic form, Nexus means you have a certain level of connection with the state so that the state has the power to tax you. But that word Nexus has been defined in many different ways over the last few years. So I think everyone can kind of understand a very basic example where I have a building or property, my business is located in a particular state. There you have physical presence nexus. And so you will have potentially some type of state tax obligation. Where it gets a little bit more complex is when you think about things like I have employees in a state. Maybe, with the last few years, companies have been hiring remote workers like crazy. The remote working has really opened up the opportunities for different employment. But, what does that mean from a state tax perspective once you've hired someone in a state where your company in your mind isn't really located? And that too can give you physical presence where you might have an income tax filing obligation. It gets even more complex when we start thinking about what it is that you're doing as a business and where your customers are located. That's another analysis that needs to happen, from a Nexus perspective, because based on the state rules, and as you mentioned, we have 50 different states. And so one of the joys of working in state tax is all of those rules are different, and they like to change them all the time. So it's really important that you keep up on what the rules are. But having customers in a certain location or providing a certain type of service can also give you Nexus so that you now have a state filing obligation.
Yeah, I mean, there's nothing simple about Nexus here. It's gotten complicated, especially in the modern day with the advancement of the internet and technology. It's just now it's so much easier to sell to anywhere in the world. Okay, especially if we're just talking about here in the United States, all 50 states. So there's kind of a difference between physical and economic nexus. Okay, this is something economic nexus is something that's come across. It's not even that old. It's really happened a lot with the Wayfair case and everything. Can you just give us a little bit of? You talked a little bit about, but a little bit more about what's the difference between having physical nexus and having economic nexus?
Right. So physical presence is having that location, that employee, that property physically located in a state. And I think a lot of people can kind of get their arms around what that means. The economic nexus rules are a little different. And so, as you mentioned, they really blew up around the Supreme Court case, the Wayfair decision, where it was a South Dakota case where they had instituted a rule that said if you had a certain level of activity in the state. So not necessarily any physical presence, but you have a certain number of transactions or a certain level of gross receipts from your activities in the state, you're really availing yourself of that state's market. And so the state felt like they should have the power to tax. And so the case made its way all the way up to the Supreme Court. And the Supreme Court said, yes, it does make sense that if you have a certain level of activity in a state, the state should be able to tax you as well, beyond just that physical presence. And so all the states jumped on the bandwagon and started passing laws that looked similar to what the Supreme Court had sort of blessed in the Wayfair decision. Now, they're not all the same. Those thresholds are different by state. They also can take different things into consideration in determining those thresholds. So some look at number of transactions and threshold levels of activity. Some just look at thresholds of level of activity. Some consider all your sales. Some pull out any exempt sales if you have anything where it's an exempt sale. So it really is a complex analysis that we encourage our clients to do on a regular basis, particularly if you are growing and expanding and your business is changing, your customer base changes. You really need to look into those rules, because you may think you're safe because you don't have that physical presence, but the economic nexus is really the states that the states are really attacking these days.
One thing to keep in mind with Nexus is you can actually have Nexus in multiple states. So a lot of taxpayers and businesses will actually find out I have Nexus in more than just one state, and actually could have multiple state requirements on that. So Melody, go into there's a thing called residency and domicile states, and then there's other states outside of that where I'm just doing business at it, and how that could create a multiple state tax compliance requirement.
Sure. So certainly where you're doing your business, we mentioned that already. So the activities where your real estate's located, or maybe where you have employees, those would be, definitely states that you would have Nexus where you should consider filing. The other thing that you need to consider, particularly when you are dealing with flow-through entities, so entities that are not C Corps, but either LLCs or partnerships or your S Corps, a lot of states require that there be filings if the owners of those entities are residents. So that can pull in a state where you may not think that you have Nexus because you don't maybe have physical presence or really even any customers there. But now you have a filing requirement because one of your owners is a resident of that state. So that's another layer of analysis that needs to be done when you're considering what states you need to file in.
Yeah, that's an important thing to talk about here. It's just there's multiple things that can create basically a tax return requirement. Some states require a tax return just because one of your owners is a resident in that state, even if you're not doing business in that state. So you have to know which states those are. That's one we see get missed a lot. We get some new clients that come in, and almost all of them, I have to tell them, hey, you have a state requirement. And they're like, but we're not doing business in that state. But I'm like, unfortunately, you have owners, especially if you, with real estate, if you're doing one of them, a big syndication or fund or some kind of group that you're doing, you got to look at the owners, see where all their residents are, see what type of entity is the owner, because it's not always individuals. Sometimes it's other pass-through entities or corporations or trusts, and they all have different rules and states. So it's just getting very complex, and this is one that probably gets overlooked. And then you mentioned it before, employees. It's so easy now to have remote employees. It's almost like, oh, yep, here it is. Well, that's creating state compliance when you do it, when you have a remote employee in a different state. I'm not doing business in that state, but now I have a physical nexus in that state because I have an employee in that state. Does that create nexus and create a state tax requirement? States fortunately are getting a little bit more lenient, being like, hey, it's very common to have a state, remote employee. So there might be a threshold you have to meet, but just realize if I got employees in those states, most likely I might have to be filing in those states. And then if you get really complex, you start getting into the tier structure of partnership entities. Or just pass-through entities in general. That's basically when I have a pass-through that passes through another pass-through that goes to another pass-through before it actually gets to the real beneficiaries, the individuals that own it. How can that make states even more complex, Melody?
Yeah, so I think this is another area that gets missed a lot because everyone thinks of them as separate legal entities, which they are. But because they're flow through entities, the activity of one flows into another. So a lot of times, particularly in the real estate space, you have maybe a lower tier entity that holds the real estate, right? So it's the one with the physical presence. And the upper tier entities may not really have any activity on their own. They're put there for other reasons, for legal reasons. And so people don't think of them as, oh, that entity doesn't necessarily have activity in the state. So I don't have to think about that one. But what's happening is that income flows up, that nexus flows up as well. So anywhere that lower tier flow through entity has physical presence nexus or any other type of nexus, that flows up into the next entity. And that potentially triggers a filing obligation for that entity. And that continues up the chain. So that's something you really have to think about when you're looking at your structures and where your entities should be filing. A lot of these states have minimum taxes. So even if there really isn't a lot of activity going on in those upper tier entities, they might still be due the minimum tax just because they have an entity that's doing business in the jurisdiction.
And that's important, especially with the real estate. A lot of times we have these tier structures. You have a holding company or a management company or some kind of general partner company that is owning these lower tiers where it has the real estate, and they just realize like, hey, even though I don't technically have a direct interest in this real estate, I have ownership in it. I'm getting a K1 from these states. Now I have a filing requirement in those states to make sure that it is getting to the real beneficial owners who then potentially have a state requirement in those states as well. So it can just get really complicated, especially if you have those tier structures. It's just important to always keep in the back of your mind, hey, if I'm doing any business in a state, I probably have a state compliance, and I probably need to be talking to a professional about this.
Yeah, and we've seen states really go after the those upper tier entities. And so it's really important that you are doing the filings and producing the K1s for those owners so that they know where the activity is happening. We've seen states really get aggressive in that space. And in some cases, I've had clients where there wasn't even an awareness that there was Nexus because they didn't get the proper information from the investment that they were invested in. But this state doesn't care. They said, you have the nexus, you owe the liability. And then, of course, because the filing wasn't done, there's potential interest and penalties on top of, any liability that they owed.
Yeah, I mean, all these people, if you're filing in states, you got to, there's extensions, there's maybe estimated tax payments. This is actually a great transition to our next topic, which is basically like state non-resident withholding. So a lot of times these states will have a withholding requirement if they know the owners are outside of the state. And this basically just says, hey, we're going to require you to withhold, this money, which basically then says you need to file in our state if you want any kind of refund, right? You're supposed to already be filing in the state. You should be complying with the rules, but they realize that a lot of people don't always comply or don't even know to comply. So this is just a way of forcing those people to comply, and they get their money up front first instead of waiting on it. So if you have any kind of owners of a business that has any kind of income producing property that is outside, that are non-residents of the state where this income is or this sale is or anything, it could produce this state non-resident withholding requirement. For instance, with real estate, it's very easy. I'm selling some real estate in a state. I own it, but I do not live in that state. That state at closing is most likely going to have a requirement that I have to withhold at X amount. Every state is a little bit different here. And then when I file my tax return in that state, then my true tax will be determined and if I can get a refund. So they're usually taking more out than I need to actually pay. This is their way of making you comply, because if you don't file, then they get to keep the money. So they're usually not making you take out less. So Melody, give us a little bit more information on what state non-resident withholding is.
Right. So state non-resident withholding can really happen in a couple different areas. You described one where you sell a piece of real estate and the withholding is required on at the point of the sale. And as you mentioned, it's exactly what you described. It's the state's way of basically guaranteeing that they get the tax associated with the income from the sale. And so that is a burden on the entity to make sure that they've withheld that money and then, reported it and delivered it to the state, but also reported that information to the owner of the business. The other way that state withholding is done is just through your annual income associated with the activity that you have going on. So you don't even necessarily have to sell anything, but if you're an income producing entity and you have Nexus in a jurisdiction, you're reporting income on your tax return. The owners of those businesses, as I mentioned, that are non-residents, now have Nexus in that state because they're owners in a business that is doing business in that jurisdiction. So we talked about income tax liability or income tax nexus. That applies not only to the entity, but to the owners of the business as well in a flow-through situation. And so the states don't necessarily have jurisdiction over, let's just take an individual, for instance. If you've got, an individual that's a Florida resident, but they're invested in a partnership that's got real estate all over the country and they're making money, investment money from that, all that activity over the country is giving Nexus in those different states. So let's say it's an individual who's a Florida resident, but they have Nexus through their investment in Georgia. So they're now technically have Nexus in Georgia as well as an owner of an entity that's doing business in Georgia. So Georgia doesn't really have any jurisdiction over that non-resident in Georgia. They're a Florida resident. So the way that Georgia ensures that it gets its money is it requires the entity, the partnership, to withhold on the income that's reported to the individual owner. So, and the same situation applies. So the owner has the decision to whether they want to file in Georgia and potentially get some of that refund, because these withholding rates are typically at the highest individual levels. Whereas when they actually go through the mechanics of doing their own return, they probably will find they're not at the highest individual level. So they have the potential to get some of that refund back. But we do have clients that choose not to file and, let the state keep the money that it has. That's, again, an analysis that has to be done every year and looking at the activity of the entity and what the threshold is for the owner in terms of whether they want to try to file another return. Because, again, that's another filing that is, another administrative burden on the owner to try to get some of that withholding back.
This is much simpler if one person owns real estate out of state. Like at the closing, I'm going to have a withholding requirement. They withhold it, I file the return. When I turn around and file my tax return next year. That one's not super complicated, but when you start having funds where you have investors, the management group just needs to understand, there's probably anytime I make even just income, even if I don't sell a property, I might have a non-resident withholding requirement for my non-resident partners, which you could be a lot of them, or could be some of them. So some you might not. So you got to understand which ones you have it. Then especially on the year of the sale, so if I have a big multi-family fund, with hundreds of investors on that date, that sale, you need to realize, hey, I need to hold money back for this payment that I'm required to make to the states. I mean, how many times have we seen in Melody where the company, unfortunately, distributes money, and then they have to do basically a capital call to all the people they gave money to, and hey, we were supposed to file non-resident withholding in that state. And the worst thing to do is tell all your investors, hey, to please make a capital call for all the proceeds I gave you, just so I can pay taxes, so you can file the return and then get that money back. So it sounds like, it's just a lot of extra. So it's just when the sale happens, before you do all your final distributions, really need to understand, talk to a professional, do I have this withholding requirement? And then what is the actual amount? Another thing also with pass-through entities, and again, this is getting complicated, so we're going to kind of keep this simple, is even if you don't have a withholding requirement, sometimes the state returns will have a composite or a pass-through entity tax, or you have the election. It might even be an option. Sometimes it's a requirement, sometimes it's an option. It's basically saying, hey, I have income, so instead of paying it at the individual level, it passes through. I'm paying it at the entity level. Okay, so the entity is paying on behalf of its owners, and then the individual gets the benefit, or it just pays it and they don't have to report it. Tari, can you talk a little bit about kind of composite and PTTs?
Yeah, so this area has gotten very complex over the last, I'll say, 2 to 3 years. It really grew out of, I mean, we already have the Nexus considerations that we've been talking about and thinking about where you need to file. And then now we've added another layer of complexity with these pass-through entity taxes. So basically, it boils down to the fact that the owner of the entity has Nexus and has a filing obligation. But at this point, there are different ways that that filing obligation can be satisfied. So withholding is actually one version of satisfying not necessarily the filing obligation, but that the tax was paid on time. And we talked about that. The other two animals there are is the composite return. So that it's similar to withholding in the sense that the tax is withheld or paid on behalf of the entity, or I'm sorry, on behalf of the owner. But that filing is also satisfies the owner's filing obligation. Whereas the withholding is just turning over the money. The composite filing is not only turning over the money, it is also filing on behalf of that owner. So now the owner doesn't have to worry about filing. There are some pros and cons to that. Composite rates are typically, like the withholding rates, the highest individual rates. So it might behoove an owner to say, you know what, never mind, go ahead and withhold, and then I'll go ahead and file my own return and get a refund. Because once you're locked into that composite, you don't have the ability, usually, depends on the state, but in most states, you don't have the ability to go in and file another return to try to get some of that money back. You're taking the, it's a way to kind of take the administrative burden off of owners that don't have any other activities going on in that state. So that's kind of the way we went along for many, many years. And then about 3 years ago, this pass-through entity tax that you mentioned kind of came into existence. And it really grew out of the cap on the federal side of individuals. They're limited by the amount of state tax deduction that they can take. And so someone creatively came up with a workaround to kind of bypass that a bit. So basically what it does is instead of taxing the individual, which both withholding and composites are taxing the owners, it shifts the burden of tax to the entity itself. So instead of the owners being subject to tax, it's now the partnership or the S corp, the actual entity that is subject to tax. And so the states are really indifferent as to which way you go, because at the end of the day, they still get the same dollar. So that's why they've said, hey, you want to do this? That's fine. So I forget how many states there are now that have pass-through entity elections. It's almost everybody that has some sort of individual tax return. There's only about 3 or 4 that don't have this option. It's usually elective. There is a state where it's not, but I think even that's going away next year, so that it will be elective for everybody. You really have to think through whether you want to make this election, because some of them you lock in like for perpetuity. Some are annual lock-ins. But when you're shifting the burden to the entity as the taxpayer, now the entity has additional filing requirements like estimated payments that maybe they didn't have before because they weren't the taxpayer. They were just the reporter of information. And now they will have to actually make cash tax payments to their shareholders, or to the, sorry, not shareholders, to their owners. So that's really an analysis that we recommend companies do year by year, because the rules have been changing. There's been more guidance on what to do and just how to report that information. And you can choose one in one state and one in another. So that's another thing to consider. All these states are different with different rules. So you could choose to do the pass-through entity tax in one state, do composite in another, and withholding in a third. So that's a lot to sort of track and keep up with year after year, and make sure that you're filing the correct forms, because the other layer of complexity in all of this is that the states often have all 3 of those avenues reported on different forms. So that's another thing that they need to be mindful of.
Well, that was sounded pretty complicated.
I know I try not to go into the weeds. It's really hard because there's so many different moving parts. But I think the main takeaway is you really need to look at this year by year, particularly if you have, a lot of activity in different states, because there could be a benefit to you on the federal side as well, in taking advantage of some of these elections on the state side.
Well, hopefully we haven't scared off our audience yet with all the state compliance requirements. So I want to move a little bit away from income tax requirements and move to some of the other requirements. We are primarily located in Florida, so a lot of our clients are in Florida or at least have real estate in Florida. And what a lot of people don't know, because Florida is the only state that even has this, is that Florida actually has a commercial rental sales tax. Okay. It only affects commercial rentals, so it does not affect residential rentals. But commercial rentals could include short-term rentals. What people don't realize is short-term rentals technically are considered commercial rentals because they're kind of the equivalent of like what a hotel is and thing. And so they might actually have a sales tax obligation. Melody, can you talk a little bit about Florida's commercial sales tax and kind of what's the current rate and what the future looks like for this?
Sure. So as you mentioned, we're kind of a unicorn in this space, and the only state that really has a commercial sales tax. It has, and the rate has varied over the last few years. I think it's an area that the legislature and the Florida government recognize as a potential impediment to business growth in the state. When you're the only state taxing this way, there's other states that people might consider investing in or doing business in that don't have this additional tax burden. So over the years, the rate has fluctuated a bit. I think at its peak, it's been 5.5% at the state level. Should also note that every county in Florida has the opportunity to add up to 2%, I think are the rules these days, of additional sales tax on top of that. So those get added to the commercial sales tax as well. We did have some legislation here recently that put some parameters in place to reduce the commercial sales tax. And so it was tied to the reemployment trust fund, so the unemployment trust fund that was decimated due to COVID. And so once the unemployment trust fund went up to a certain level, it was in the legislature that the rate would go down to 2%. And so we did achieve that metric. And in June, the rate went down to 2%. So currently the rate is 2%. That is the state rate. And again, the counties have the ability to add 1 to 2% or even 0.5% up to 2% on addition to that 2%. So you need to be mindful of where your real estate is located, what county you're in, so that you are collecting the correct amount of sales tax.
So if you have any kind of commercial real estate, you just realize you should be collecting the remaining sales tax on those rents, okay? Which means you need to register with the Department of Revenue for sales tax, and then you need to file sales tax returns. The frequency we see of those sales tax returns kind of just determines on how much revenue it usually is, but it could be a monthly, it could be quarterly, it could be annually. The state will tell you that and determine if you need to change your frequency. But just realize that you need to be registering with the state, and you should be collecting remaining sales tax. One of the issues that probably gets missed a lot when we're talking about real estate is self-rentals. Okay, it's very popular that I have my business or operations in one entity, and I have my real property in a different entity. Okay, and for legal purposes, for whatever legal asset protection, whatever reason why, it's very popular. What people don't understand is when they do that, they potentially might have created an actual commercial rental and might still be subject to this commercial sales tax, okay? Even if you don't actually make rent payments, okay? Now, if you actually make rent payments, then you're kind of stuck with it. You need to be making it. But there's this thing called construed rent, okay? Which basically means, hey, if the entity that is the self-rental is really paying for the mortgage, the property tax, the insurance, this is deemed rent. And the Florida State Department of Revenue could come after you and say, this is construed rent and you should still be collecting or remitting sales tax, even though you're not actually paying rent.
Look at you. You're such a state tax expert.
I know. I was gonna say, Melody, expand on that, and I was like, I think I said the whole thing. But do you have anything else to add on that subject?
No, I'll just say this is an area that the state of Florida loves to audit. So if you are audited for any reason, they will often, and you lease property, whether you're the lessor or the lessee, they will ask for your contracts. They will ask you for whether you're paying sales tax on your commercial rent. It's also, as Daniel said, not just limited to, third parties internally. You have to remember that from a sales tax perspective, the Department of Revenue views each entity as a separate entity. It doesn't matter if they have common ownership. It doesn't matter if they're flow-through entities for income tax purposes. If they are legal separate entities, and for sales tax purposes, they are legal separate entities. There is no flow-through concept in sales tax, in the sales tax world. The other thing I'll just note is that it is an obligation of the lessor, but the department can go after the lessor or the lessee. So if you don't think just because you're not being charged the sales tax by a third party, you're off the hook. If you are audited for any case, then they will look at it. And if you're not paying it, they will assess it to you. So that is something to consider, a little unique in the sales tax space, that they can go after either the lessor or the lessee.
Yeah, thanks, Mallory. We just want to make sure that anyone in our audience is just understanding that there's a commercial sales tax in Florida, and your self-rental might be subject to it. And if you're not currently paying any kind of sales tax, you might want to talk to a professional and make sure that you don't basically have a reporting requirement that where if the Department of Revenue ever finds out and comes after you, it's a lot worse, basically. There's penalties, there's interest, it's a headache. You want to be out in front of it if you can, if you know you have a reporting requirement and you haven't been doing it in the past. Thank you for tuning into today's episode. We hope you found our discussion insightful, and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Thanks to Melody for joining us. Her insight on state and local taxes is a huge asset to James Moore, and we're just glad that she was able to provide some valuable information to our audience. Join us next time for more expert insight and tax strategies to help you maximize your real estate investments. Until then, stay informed, stay proactive, and be happy investing.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.